Hello and welcome. You're watching BQ Conversations. Divergence between economic growth and equity market performance was the key global takeaway of 2019. What lies in store for 2020? Let's ask a very special guest. James Sullivan of JPMorgan is joining me right now on this special conversation. James, thanks very much for taking out the time and speaking with us. It's the start of the year. It started off with very crucial moving parts where global markets along with the Indian equity markets have made record highs. We've seen a bout of correction coming in as well. Geopolitical risk, the signing of, the first deal of the trade truce, so that's now set aside for some time. What is it that's going to be the most crucial to watch out for come 2020?
So the underlying backdrop from a JPMorgan perspective, I think, is relatively clear. The earnings strength that drove a significant amount of equity market performance in 2019, we do expect to continue. We're currently seeing 78 to 80% of S&P companies beat earning expectations. That's one of the highest levels that we've seen over the course of the past 30 years. And we do think that that will continue to provide a bid for equity markets. One of the biggest issues that we started to talk about towards the tail end of last year and forms really the crux of our equity market strategy for 2020 is a belief that the shift that we started to see in fourth quarter of last year from momentum into value will continue. On JPMorgan analysis, that shift is only about 40% done. That's very positive, in particular for emerging markets over developed markets. We are overweight EM versus DM, and we do expect that that trade will continue.
And that overweight, with regards to emerging markets, comes on the back of what hypothesis with regards to growth, whether or not you do see growth being a major driver of flows into emerging markets, because that seems to be missing as of now.
Absolutely, and you hit on one of the most critical elements that we talk about with investors on an ongoing basis. Ultimately, EM performance is driven by growth differentials relative to primarily the U.S., but developed markets in general. One of the things that we started to see towards the second half of last year was a narrowing of that growth gap. The U.S. had been outperforming significantly over the course of the past couple of years. We finally started to see economic data troughing out in markets like China, where we see incremental signs of demand. We can talk about the risks to that demand in a second. And even in markets like India, where we argue that the street is too focused on year-on-year GDP trends. Anytime we do that, we're generally going to miss the inflection point or miss the trough. If you start looking at quarter-on-quarter trends, we are seeing a sign of a bottoming of the Indian economy. That bodes very, very well for the positive inflection in terms of growth differential relative to the U.S. and broader developed markets. As EM grows faster than the U.S., that generally, historically at least, has triggered very significant inflows into emerging markets.
So, let's talk about those risks that you alluded to with regards to, countries like India. And where does India stand within that list of emerging markets in terms of investment?
So we see the Indian market bottoming. The two critical elements of the call on India right now, and we aren't neutral on the Indian market, what keeps us from an overweighting are two things. Number one, valuation. Number two, the Indian market has been very, very aggressively owned by emerging market investors over the course of the last couple of years. On JPMorgan statistics, it was one of the most over-owned emerging markets throughout the course of much of 2019. You put that positioning as well as valuation component together, and it makes it very difficult to see sustained aggressive outperformance of the Indian market. That said, within that, we do see very significant opportunities for stock picking. We are seeing, in our view, a bottoming of the financial sector. The incremental changes that we're seeing in legislation like bankruptcy laws, the ability of companies to work through their debt on a more expedited basis, we see as very positive for financials as well as NBFCs. We're positive on utilities and materials. Offsetting that, we still remain very cautious on sectors like communications. And so despite the neutral recommendation, we do see very clear opportunities for alpha generation, very clear opportunities for investors to make money in the Indian market in 2020.
So that's one aspect of it. While you say that there was an over-ownership in 2019, in the weightage of 9% that it has in the MSCI index, that didn't scale up too much, unlike what we saw, the kind of premium that investors paid in 2014 when the Modi government first came into power, where there was a significant premium over that 9% weightage that India got. So it's not moved the needle much this time around, but nonetheless, if you're saying that India has the potential to go and give you those kind of gains, is that going to be substantial versus other countries in the emerging market back? Because it seems like North Asia, you've got countries like Vietnam and even China for that matter, which seem to be better placed than India at this point.
I wouldn't disagree with that statement. Again, one of the things that drives the neutral on the overall market, despite positivity on several of the large underlying segments, are incremental opportunities that we see elsewhere. As we start to see global trade pick back up, we have turned more positive on some of the North Asian export-oriented markets like Korea and Taiwan. Incrementally, as we said earlier in the program, we are seeing signs of economic bottoming in China. There's clearly short-term risks that market is going to work through over the course of the next month/quarter. But we do see very clear opportunities across the rest of Asia as well as global emerging markets. From an Asia ex-Japan perspective, our top picks from a country perspective at the moment would be Korea and Taiwan.
Do you see liquidity being ample in 2020? We've seen central banks loosening their purse strings quite a bit in 2019, which is primarily the reason why much of the flows have gone into equity markets globally. At this point, does it seem like they could withhold a bit, or that doesn't seem to be the case?
Liquidity was a very important part of the story in 2019. We saw the market enter 2019 with significant negative rates in many markets. Excuse me. We then saw an additional 100 basis points of loosening as we went through 2019. JPMorgan forecasts call for rate cuts in the US, China, potentially the UK, dependent on the data, as well as some of the high-yielding emerging markets. So we see continual provision of liquidity. The important point to make here, though, is most of that will occur in the first half. And if you look at our equity index targets for most markets around the world, we have that performance really peaking as we get to mid-year. And we are expecting a weaker second half for markets. And so we are arguing for investors to effectively have full positioning now through about mid-year. At that point, we would start to get a little bit more cautious with the overweight positions.
Okay. In terms of specifically with regards to growth, the IMF's new forecast of 4.8% GDP growth for India, does that worry you?
We wouldn't disagree with that. Excuse me. We've taken down our growth expectations for India a number of times over the course of the past couple of quarters. I think one of the key backdrops that's very important for investors as well as governments, frankly, to think through are the changes that we're seeing in terms of the backdrop for structural global growth. One of the arguments behind the trade frictions that we're seeing primarily between the US and China, although there are obviously other countries involved in that conversation, our belief from a JPMorgan perspective is despite the signing of phase one of the trade deal, these frictions will not go away. We've suggested in previous programs that what we're witnessing is a realignment of how the global economy works. We're seeing the rise of a multilateral, multipolar world. As we go through that conversation, it is difficult. You are looking at rearranging of a lot of the different underlying trade relationships. By definition, that is not a productivity driving conversation. So if global productivity is set to stall because of this realignment process, then by definition, the possible economic growth that the world is facing is reduced. And so the backdrop that we're looking at, not just for India, but for markets around the world, has changed in very meaningful, fundamental ways from a JPMorgan perspective. And that is not to the positive, it's to the negative. So I think we have to recognize that benchmarking against the average growth rates of the past 5, 10, 15 years is probably the wrong approach. Breaking out economic growth into its various underlying constituents and understanding the moving parts of those constituents is absolutely critical. And we'd be very, very squarely focused on incremental trends in global trade, as well as the impact that it will very likely have on productivity.
Do you feel things materially changing? Because obviously, China is the heart of, the Asian economic sentiment. Do you feel things materially change out there in order to make sure that the rest of the Asian pack also gets its fair share of the pie?
So China has certainly been sort of the beating heart of the Asian economy for a while now, if you will. I think one of the critical elements that we're seeing come to the fore is the rise of intra-Asia trade. And so one of the conversations that we've had with investors off the back of the trade frictions between China and the US is recognizing the reality that a very, very large percentage of trade pan-Asia stays within Asia. And you're looking at the integration of supply chains across ASEAN, across Asia-Pac as a region in a way that you really haven't seen. You're effectively deglobalizing and regionalizing supply chains. The positive impact of that is it reduces the risk that global stress impacts Asia, and it allows for differential sources of growth moving forward. And so one of the key trends that we're very, very focused on is this move of supply chains, this move of economic linkage from a global to a regional footprint.
You know, in fact, when we spoke to you last in September during the JPMorgan conference in India, at that point, we were right in the middle of the trade tensions. We were not too sure whether the first deal would be signed or no. And at that point, we were talking about India making its footprint in the global supply chain because of the kind of opening up of the manufacturing sector that the government has been doing, and that would shift a lot of manufacturing to a country like India. Does that change your perspective now?
So I would absolutely stand by my comments during the course of the summit. I think that what we're looking at is really a once-in-a-lifetime opportunity for India to make very specific targeted investments, very specific changes to legislation to allow itself to be the primary destination for the supply chain reorganization that we're seeing. What we argued then and what I would continue to argue now, the supply chain reorganization that's been triggered by the trade tensions will not reverse if trade deals are signed incrementally. And to be clear, incremental trade deals are not JPMorgan's base case. We think that the incremental deals from here will be very, very difficult to achieve. But even if they were, you're looking at major multinational companies diversify their supply chains, not just out of China, but within China, but certainly into other markets around the APAC region. India is, as we said at the conference, the only market that is large enough, that has a large enough local supply chain to handle the bulk of these flows. Vietnam, markets of that nature have gotten the majority of the press ink. These economies are not large enough to take the flows coming out of China. So I think India is incredibly well positioned to be the prime recipient of these flows. We do need to see significant incremental investments in things like basic infrastructure, roads, rail, overall transport links between India, but also within India. We'd also like to see significant incremental legislative changes, particularly on the land title and land use side of things. And so I think if these changes are made, it really is a once-in-a-lifetime opportunity for India to restructure its economy towards an export-driven, globally oriented economy in a way that they perhaps didn't have access to before because of the primacy of China.
So in light of that, actually, I want to just pull that point forward. Then the budget becomes really important because we're going to get a focus on what they've got in store for infrastructure spending, how much additional capex are they ready to do, and how they're going to tackle the growth slowdown and spur demand back. So we know that the government is proactive in fixing the supply side issues, but they've not really done a whole lot much to make sure the demand comes back on track. And in that light, do you feel the budget this time around, which happens on the 1st of Feb, is going to be that much more important?
The budget's absolutely critical, and the reality of the budget in particular in this year is that there's a very clear tightrope being walked. We saw the corporate tax cut at the end of 2019 that obviously increased the fiscal deficit and made the overall fiscal position of the government slightly more difficult. Will there be policy contained in the budget to encourage private companies to spend that tax cut on infrastructure investment, on capex that will benefit growth across the overall Indian economy? The steps that the Indian central government can take are more limited now than they have been in the past, given the size of the fiscal deficit. The ability of the government to continue to push on the monetary side without triggering significant inflation, which we are seeing firming up. Again, there are pushes and takes at play in this budget that I think will make the document incredibly important. If JPMorgan's argument is correct that we are seeing a troughing out and a bottoming out of the economic slowdown in India, the ability of the government to step up and really provide a helping hand to reignite growth will be extremely important.
Right. I mean, that's going to be critical as well. James, one last question, and that's on the most recent event, which is, the risk of contagion of the coronavirus and the impact that you think that could have with regards to investor sentiment. That there are talks of whether or not ahead of the Lunar Year celebrations, Asian funds will start to pull money off the table and take a call post the Lunar Year celebrations. Do you think this is a big risk?
So from a markets perspective, yes, and we've already started to see that play out. We have seen markets wobbling off the back of the news flow coming out of China. If we look back to the SARS crisis in 2003, however, what we very clearly see is a delay of demand, not a destruction of demand. And you saw an economic slowdown in China in the second quarter of 2003. Third and fourth quarter, however, largely brought that growth back onto the table. At the moment, we would expect to see similar dynamics here in 2020. The timing of SARS and the timing of the coronavirus are almost exactly the same. The first reported case of human-to-human transition in 2003 was January 19th. In 2020 was January 20th. Lunar New Year is at almost the exact same week. 2003 was late February. We're now similar time, early February, late January. We're now early February. So it's very, very similar time frames in terms of the mass migration that we see in China. The critical element this side, from our perspective, is that the government in China has taken far more aggressive steps to try and contain the virus. In 2003, it was roughly 4 months between the first reported case and very significant aggressive steps being taken by the central government. In this instance, that time lapse has narrowed down to only 1 month. So we are seeing significantly more aggressive steps taken. You're seeing effectively a quarantine of almost the entire city of Wuhan, and that does lead us to a potentially more positive conclusion. But again, it's, in our view, a delay of demand, not a destruction of demand.
Great. Thanks so much, James. It was a pleasure chatting with you and getting your perspective. Appreciate it. James Sullivan there of JPMorgan, talking about JPMorgan's outlook for 2020. India still could be a market which could give you decent returns in this year. Thanks a lot for watching.